Hey everyone, today we are diving deep into a company that could become one of the most disruptive players in modern healthcare. The name of this company is TransMedics and the ticker is TMDX. I'm gonna start with their business to understand what they actually do. Then we will see its business moat and competitive advantage. And then finally, I'll do a fundamental analysis of its stock to understand the risk associated with it. So what do they do? TransMedics has developed Organ Care System (OCS). It is a portable, FDA-approved device to keep human organs like hearts, lungs, and livers alive and functioning outside the body during transport. It is one of its kind. You may think of it as a next-gen alternative to store organs on the ice. And why is this a big deal? Because with OCS, more organs becomes viable for transplants. Fewer are rejected and an entire ecosystem becomes more efficient. This is not just a medical innovation, but it is life-saving logistics. Now let's understand the business mode and competitive advantage. TransMedics is first to market with FDA approval for all the three major organs. It works on a razor and blade model, which means each transplant needs a single-use kit and a recurring expense for logistical services for the delivery. Their business model is also quite sticky. Hospitals and transplant centers using OCS get tied in deeply due to training, workflow integration, and service contracts. They in fact own the aviation fleet for all the logistical services. In a nutshell, they own the device, the data, the logistics and customer relationships. This gives them a powerful competitive moat. But as usual, not everything is without risk. The company sits at a high valuation. The stock trades at a high price to earning ratio, meaning investors are paying premium based on future growth expectations. Second point to note is the debt. The company is using debt to scale. However, it is common for a growth company. Execution risk is also something which needs to be considered. If adoption slows, for example, hospital faces budget pressure. In those cases, growth may miss forecasts. But just note that these 3 points are something which is quite common in any high growth company. Fourth point to watch out for is legal scrutiny. The company is facing legal allegations for aggressive billing and marketing tactics. So if you are not comfortable with this fourth point, you may choose to stay out. Now let's go over some financial key matrices to understand the fundamentals of the company. TransMedics made a revenue of $488 million over the last 12 months. It has grown 50% year on year, which shows high demand. The net income of the company is $49 million. It has become profitable recently. Earning per share, which means how much each share has earned over the last year, is 1.47. Price to earning ratio is 84x. It is high, but it is common in high growth company. It basically means investors are paying $84 for each $1 of earnings. Forward price to earning ratio is 65x. Note that it is lower than trailing price to earning ratio, which indicates the earnings are estimated to grow. Gross margins are profitability after the cost of goods and it is 60%. Operating margin is 10% and it is rising, indicating scaling efficiency. Return on equity is 22%, which is excellent. It means efficient use of shareholder funds. Debt to equity is quite high, it is 1.95x, but it is acceptable as long as profit continues to rise. As company is investing heavily on infrastructure, therefore free cash flow is negative. Now let's do a quick technical analysis. Most of the indicators suggest a bullish signal on a mid-term to long-term basis. Since the current stock price is lower than 10-day and 20-day moving average, so we can expect a consolidation phase or a pullback. However, it is higher than 50-day and 200-day moving average. So in mid-term and long-term, trend remain bullish. RSI indicates that it is in neutral zone, neither oversold nor overbought. MACD is slightly bullish, and Commodity Channel Index CCI indicates increasing positive momentum, which is again bullish trend. So the golden question, is TMDX worth buying? Well, if you are a long-term investor with belief in MedTech innovation and can stomach some volatility in the market, then yes, it is a strong buy for long-term investor. However, if you are one of those looking for a short-term gain or low-risk income, then this might not be a good fit for you. If the growth continues as expected, then today's expensive valuation may look cheap in 2 to 3 years. So bottom line, TMDX is not a cheap bargain. However, it is a quality disruptor, and for investor with patience, it could deliver life-saving returns in more ways than one. If you like this content, please follow and subscribe me. Thanks for watching.